Hello, everyone. Welcome to episode 7 of the Naked Truth in Multifamily. And Quentin, please keep your clothes on. I want to introduce Quentin D'Souza, my good buddy from Whitby, Ontario. He's built an amazing portfolio in a very short time. In fact, he doubled during COVID. He went from 40 million to probably 125 million plus. And it sounds like you're closing on even more deals. Welcome to the show, Quentin D'Souza.
Hey, I'm doing well, and thanks for having me. And I won't get naked here, so just so we're all clear, I never agreed to getting naked anywhere. Okay, Cory, what kind of show is this? You're
Well,
crazy.
you just said you worked out this morning, so you must be a fit specimen.
I'm working on it. I've lost a lot of weight, and I focus on my health a lot. I'm climbing Kilimanjaro in February, so I'm doing that trip. And I went to do the Inca Trail with my oldest son in June. So I've been focusing on the health. And I find for me what works really well is having different bigger goals set, and having to be ready for them. So it just puts me in the right frame of mind, but also like I have to be healthy in order to complete the hike, or be able to complete the climb. So those goals are just things that I do to kind of keep me on track.
Yeah, that's a pretty lofty one. Like that's pretty aggressive. I know guys that have done the West Coast Trail out on Vancouver Island. I mean, for my thing is I snowboard, but that doesn't really count. But I like Taekwondo. I compete in Taekwondo with my daughter. And having your
Mhm.
kids involved with you is just a wonderful, wonderful thing. Especially, when with our busy schedules to be able to fit that in. It's fantastic.
Yeah, absolutely. It was really nice to be able to do that trip with him. He turned 18 and he finished high school, and I wanted to do something a little different, and it was an opportunity to spend some time together with him, and that was it was really cool. So we did that for 5 days, and got cold, got warm, climbed like 15,000 feet through, I think it's called Dead Woman's Pass. And yeah, it was good. there was
Crazy.
no there was no dead women, just so that everybody's clear. Okay, don't come back and complain to Cory about the level of sophistication that he's dealing with when he's dealing with me. Okay.
We're not going to start any rumors. Okay, that's awesome. So, before we get into all that, I'm just going to introduce you a little bit more. So, you operate the Durham Real Estate Investment Club. You
Yep.
also operate I don't know how big your club is, but we'll get into that. You're also an author. You wrote 6 books. I think you
Yep.
wrote 2 during COVID.
Yep.
So, I haven't checked them out on Amazon yet, but you're an incredibly busy guy. You got a massive portfolio. Yeah, so tell me about the last year, maybe. What have you been doing?
Last year, okay, so the last year I finished the Finding Properties Toolbox book. So I finished that. I just finished the audiobook version of that. And this was like the end of 2021. And in the beginning of 2022, I worked on the audiobook. So that should be coming out soon. It's my first audiobook. I've been buying properties, especially ones that, of course, are cash flow positive in Ontario, which everybody says can't be done. And that's what we've really focused on. We're repositioning those assets and increasing their net operating income because of a niche strategy that we've developed for the last, I don't know, 6-7 years. We've been using it, and it's been quite effective. And we continue to buy apartment buildings, reposition them, refinance them, and hold them is the strategy that we focus at.
Yeah, and I notice you're really bucking the trend on that because you mentioned Ontario, and I know a lot of people, I mentor people in Ontario. They're like, man, it's so hard to find a building. They're so expensive. How do you do this? I was gracious to have Quentin as my guest on the Resilient Summit that we just did back in October. And I kind of got a sneak peek into this very unique niche strategy that he's developed specifically for Ontario because of rent controlled environment and super depressed rents, he's able to get massive rent increases on suites that I cannot get in Alberta. The same strategy would not work there. I mean, I may be able to get $150 lift per suite. So I may be able to, create a $500,000 in equity potentially on a BRRRR. But in Ontario, with what you're doing, you're getting massively higher lifts than that.
Yeah, and that's just like I mean, I have a very good sense of the market. I've been in the market since 2004. I worked my way up from single family homes and duplexes and triplexes and quad units to, you know, small apartment buildings into larger and larger. And the biggest one is a 94 unit that we've closed on. But yes, it only I have properties in Florida as well, and it just doesn't work the same way. I find that my returns are higher in Ontario because of what the nicheness of the nicheness. Is that a word? Did we make up
You
a
just
word?
made it up. You coined it. We're
The
gonna patent that one for
nicheness.
Quentin.
The nicheness of the strategy is makes it what works and why it works here. And so that's something that I think that is replicatable. Other people can do it. Other people do it. I think that some people do it well, some people do it poorly, and some people do it illegally. So we tend to follow the law and do things without getting into like into the gray zone, right? And because
Yeah.
we want to be here for the next 20 years, we don't want to be you know, have papers written about us in the future. So what we want is, you know, to kind of stay out of that and just do what we've been doing and that what's been working. And so like we're taking the net operating income of an asset, buying it for, let's say, a 4 cap or a 5 cap, whatever that is in the market. We're not buying in the Toronto area because you're never going to get cap rates like that in
Yeah.
the
300 a
area.
door, 400 a door. It's not possible.
No,
Yeah.
it becomes really challenging. But you know, if you're buying it for like 150 to 180 to 200 a door, you know, you're and the per door price really doesn't matter. It's really about the cap rate and the net operating income, right? So if you're able to buy something that's $400 or $500 below market rent on average, 80% of those units are below by $400 or $500, and you're able to turn over, let's say, you know, 40 or 50% of those units in a year or 2 or 3, then you're actually increasing the net operating income of that asset. You know, by, let's say it's a 12 unit building and you turn over 5 of those units, you're increasing the rent $2,500 per month, right? At let's say at a 4 cap. Oh, should we take out the calculator and have fun with this one? So at a 4 cap, 2,500 times 12.
Times 12 divided by 04. That's a very high number.
Yeah,
I can't do that math in my head.
750,000 lift. So
Yeah.
that's what we're talking about and how you're able to. And then what you do is you take that lifted value. Hopefully you maintain your debt coverage ratio at like a 1.2 or 1.3 throughout that process. And then then you're at a much higher value because of the cap rate of the net operating income, and your probably debt coverage is a lot more because of that increase. Now you go back, you refinance that property, and you take out the equity, and then you use that equity to go and invest again into another project, or you know, well, you do what you need to do with it. You return your investors' money. You do what's required. But usually you have people who, once they've seen the process, they reinvest again into your projects, right? So I mean, everybody that's we have a currently like 100% reinvestment rate of all our investors, which is kind of crazy, but I mean, it makes sense when
No room
you're
for newbies getting in. If I wanted to put my money with you, there's probably no opportunity.
no, there's not, like, you know what, I only work with accredited investors anyway, so
Yeah.
there's a criteria that you would have to meet in order to do that. But I'm always happy to talk to new people to work with. But I'm more interested in working with people that I like than people that are jerks, right? Like I'm not at a point where I need to do that anymore.
Yeah, at this stage in our careers, I mean, our tolerance for BS is extremely low. I mean,
Yeah.
I'm the same way when I work with investors. We have a very similar model. So for example, I could do my lift, what you're talking about in Alberta. I could do it in 8 months, you know, potentially, because I can go in there and just railroad my rents as high as I can. But it doesn't sound like I can get the same level of lift that you can in Ontario, albeit it's taking you longer, 3 to 5 years. So I'm going to segue into 2 questions on that. How do you navigate the debt service coverage ratio going in? Because obviously you're going to probably get a low loan to value. you got to bridge that gap somehow. Are you doing a bridge loan, or how are you getting from A to B in that 3 to 5 year point with financing?
Yeah, so there's a couple of ways to do it. So I can tell you what I did before, and I can tell you what I'm doing now, because it's very
Okay.
different, because interest rates have changed, right? So
Bingo.
right, so that makes it a little different. So we were actually entering into projects with CMHC on into it with a DCR of 1.2, 1.3 right from the get-go. And we were
Yeah.
getting 85% LTV. Sometimes we were getting 35-year AMs. Sometimes
Mm-hmm.
we were getting 40-year AMs on our projects, just because the debt coverage ratio and the numbers all work, right?
So a 5 year hold going in just 5 years immediately from purchase
Yeah, that's
with
right. So
CMHC. Yeah.
yeah, so you're going in with that type of debt. Sometimes you could go in with a 3-year term, but usually it was
Okay.
5-year. And what we're able to do by doing that is getting that, like our current mortgage rate locked in, but also we're getting mortgage pay down as a component of that, right?
Yeah.
Sometimes it would take longer than that we really wanted to get into CMHC, so we had to use a temporary bridge in order to get the CMHC mortgages in place, right?
Yes.
So sometimes CMHC was notoriously slow for a while there. They've gotten a lot better, but they were like, 6-9 months to get like CMHC mortgage in place. And if you're
Oh, yeah, I
closing
know
in,
exactly. Yeah, it's crazy. It was crazy. It was taking me 6 to 8. I did 2 of them, and it took me, I think, 8 months for the first, 6 months for the second. It was bad for a while there. Yeah.
yeah, so usually you'd use a short-term bridge financing, and you try to work with lenders that have bridges that are available, so that way you just use their bridge. Sometimes I was starting to
Uh,
feel like they were taking advantage of that process, making it go to a bridge, but this is what lenders do, and the more I work with them, the more I kind of feel like I'm getting taken advantage of. But
yeah, there's a 1% broker fee on the bridge, and then the points
yeah,
and
yeah.
1% renewal. Then there's another point when they go to do the other loan. What the hell?
Yeah, and I typically I don't work with brokers. I work directly with lenders because of the
Oh,
size and
interesting.
scope of what we do. Like I'll work
Right.
with
Okay.
direct to finance institutions, because I feel that there's still the fees, there's still all of that associated with it. But if the broker is just going to go to that lender anyways, there's not much point, right? The only difference is the size, right? So if you're some of the lenders, you can't go directly to them unless you're doing a certain size loan, let's say like a $15 million loan or something like that. So it just depends
Yeah,
on
it's interesting.
the size of the loan that you're doing that allows you to direct yourself to a particular lender. And then most, like CMHC, won't do a loan under $1 million usually anyways, right? So there's certain
No.
criteria that gives you what you can and can't do, and you kind of work through that. So I was saying before that we started off with CMHC, we had the debt coverage ratio. It's because of we have like deep relationships with who we're working with, and we have a good reputation. So we have a lot of deal flow that comes to us that doesn't go like, I don't think many of the projects I've ever purchased have been on, I can't think of any off the MLS off the top of my head. Most of them are like pocket listings from realtors, or a realtor who's talking to other people and have somebody that may be interested in selling, or two realtors talking and getting a deal done.
Yeah,
Usually
and this is
that's how it
you're a
works.
known closer, so you're automatically on the top of these lists. So you're the
That's
first guy they call, and then you can choose if it's a crap listing, if you want to pass on it or not. Then it may eventually get to MLS, but you kind of get that's the benefit of the experience you've had in the relationships. I would call it the relationships, just like with your lenders directly,
yeah.
and then you get that's how you can really accelerate quickly. So no, that's
Yeah,
interesting.
yeah, for sure. And so before we would go CMHC to be able to get the deals done. Now what we're looking at is assuming financing. A lot of the time, if we can assume financing and then put a second position mortgage on the property, then we can get the LTV that we want, still
Yeah.
maintain the DCR, and then continue to move on the closing and get things done. So this, like, we're closing on a 20 unit now. because it's conventional, we're able to bring down the DCR just a little bit. So we're
Yes.
able to do like a 1.1, which is nice. So what we were able to do, so in this particular case, the seller made a mistake, and they offered us 80% LTV first mortgage. But I don't think what they realized is that by doing that, they would have to bring like $3 million to the table to close, right? And so I think they were panicking there for a while.
So it
And
was a vendor take back. They wanted to offer you the financing direct. So this is part of what you were talking about. I'll just unpack what you said for some of our listeners who, he said a lot there. So the first strategy is to go directly to CMHC, borrow 85% of the money. Now, because the lenders are not lending as much, because the debt service coverage ratio, which is the net income of the property divided by the mortgage payments, because you have to maintain that same cushion. The bank wants to see that same cushion. So they've scaled the loans back significantly. I think in some of my buildings now, it's something like $300,000 or $400,000. So now to buy a building for people like Quentin and I, now where we could go to CMHC, now there's a huge shortfall. So now we have to figure out a way to buy with the same amount of money down. And now this is much trickier. So this is why he's saying we get a second mortgage. We can assume what's already there. So if someone wants to sell the building, if they have a $5 million building that has like a $2.5 million mortgage on it, we'll just assume that $2.5 million debt, but then we want to add to it to get the same loan to value. So we can do that in a couple of forms, right? There's a pari passu you can get directly from the lender, or a vendor take back from the seller. So the seller can issue back some of the financing. Now, what he's just said here is that in this particular case, the seller was willing to finance all of the financing on the property and be in the first mortgage position. Is that sort of sum up?
yeah, that's right.
That was
But
a lot.
in this case, if they were to do that, they were going to have to bring a certain amount of dollars to the table that they would have to come up with, right? So because they would let's say they were going to get the mortgage component taken care of, right? So that, let's say it's like $3 million. Okay. So that $3 million, that mortgage is being paid out, but who comes up with the $3 million, right?
Yeah.
So
Yeah.
they do.
Right.
So they'll have to come up with the $3 million to pay out the first in order to offer the VTB second on the whole piece. So
Well, they're carrying the first, aren't they? Because they're the sellers, right?
well, that's right. They have a first mortgage on the property, but in order to give us a first, let's say we needed a first for $4.5 million, right?
Yeah.
All of a sudden they have to pay out the $3 million in order to come up with the $4.5 million, right?
They can't borrow it and lend it to you at a higher rate. No,
Right.
they have to come up with it.
That's right.
So what was the logic behind that? Because they could get a higher purchase price? Is that why they considered doing that deal? I mean, why would someone want to do that?
Yeah, well, first of all, when does this episode come out? Because I want to make sure that this doesn't come out until after we close on the property. It has to come out after December.
Yeah, I'll make sure. No, don't worry about it.
December 2nd, okay?
Okay, we'll talk about it on December 2nd.
So what ends up happening now is they get panicky and go, now I think they realized how we're going to come up with this money. And so they were like, okay, we can't close. We were ready to close a month ago, and we knew that they're in a bad position. And, we want to continue to close on the property. So we're going to, work towards getting that done. So what ends up happening was we look at the current first mortgage provider, and their rate was like, I think it's like 3.3 or 3.4, something like that, which is fine. We can assume that first for the next 4 or 5 years. And what we want then is to have a second position mortgage that gives us the same amount overall we would have paid as interest only for the first and the second together. So that the rate that we're paying monthly would have been equivalent to that. Now, let's say the equivalent amount is $21,000, okay, per month. So, but what's different now even though the overall, the payment amount is the same, which is what we were able to negotiate. What do we have now with a first mortgage that's not interest only and a second mortgage that's a low rate? So it's like we've got what we ended up with is a 1.3% second mortgage. And then what we did is we deferred 0.7% till the end of the term. So we ended up with the ability to still end up with $21,000 per month payment. But now what we end up having is property, so principal pay down. Because before,
you're not getting just interest only, you're actually getting some pay down because you're doing this over a 3-year spread, right? Until you're eventually going to go to refinance with CMHC at the tail end of this. Once you have the building repositioned. 4 years. But you've taken a real torturous path to get there. This almost sounds like a deal that, if you listen to Art of the Deal by Donald Trump, it's the kind of deal that he was putting together. You know,
this is what we do, man. This is what we do. I love this stuff. This is really good creative financing that works, right? And you know, they're ending up really in the same position that they were in. Actually, they're in a better position because they don't have to come up with $3 million, right? Like how are you gonna, like, all of a sudden, you know, that's gonna be a challenge. So we're helping them, and they're following through on their agreement. So we're not suing them for not closing because we were in the position to close, right? And
turned it into a win-win. It could have just blew up, but it became a win-win. No, fabulous.
Yeah, and now we're ending up with a property that's financed with good financing from a first and a second. And then we're able to continue to reposition the asset. We've got some, and on top of that, we have the building we already have pre-approved another 20 units that we can build on the same land. So it's already like, it's the same footprint of the building. We actually have the ability to build 2 more buildings exactly the same size of those, like the first one that's 20 units and the second one that's 20 units that's already approved. There's enough land to build another 2 more buildings like those 2. So it's quite a interesting project. So aside from the financing side, right, we have the ability to do the building, and we have the building to more land to continue to do 2 more if we so choose to, or we just sever it off and sell the other 2. And you know, like there's lots of different, or sever off the new building and sell it, and pay off the old building, and or sell off the old building and keep the new building. Like lots of options. So
that's fabulous that you say this, and I'm so glad we were able to connect, because I want to just tell a short story before I ask you the next question. And this is about the word creative. So I was in a very similar situation. You know, I bought a building, a 17-suite apartment in Leduc, Alberta, Edmonton. You know, back in 2021, it was 40% vacant, needed a lot of work. I bought it for like 80 a door. You know, we did the work. You know, we got the appraisal back at 130. We did a temporary bridge loan. I think our bridge loan was around 7% interest. So once we took our carrying costs, all of our renovation costs, we were able to completely pull all of our equity and put it into another project. So now I have another building under contract. Now the world has changed. And this is where the word creative comes in, because I'm looking at this same bridge loan. This is a premium building. It's a lot more expensive. It's 125 a door, which you're probably thinking that's cheap, but for Edmonton, that's a premium building. And in this case, it's the similar situation, low rents, but it's a nice building. Now that same bridge loan, because I'm looking at the interest rate increase, which I would have to pay on this because it's a smaller loan, would cost me something like $350,000 a year. So I have to add $20,000 a door to the price to get back to where I'm at. So now I'm really trying to find a solution, like you were just alluding to, of maybe going back to the seller, getting a VTB, trying to put some kind of secondary financing. And I'm really debating whether I just want to go in, you know, a 5-year CMHC right off the hop. I may only get 70% loan to actual value, you know, because CMHC is going to value it lower because of the income, you know, but a bridge loan is off the table right now. So this is where these creative options, like maybe agreement for sale or vendor take, you know, will come into play.
Or seeing what they have in their first mortgage right now, right? And
that's assumable.
If it's assumable, then you can try to take that on and save some funds. And that could be right, because now as we've changed from lower interest environments to, and as interest rates increase, that lower interest debt actually has value now. So if somebody can,
massively. Yeah.
So if you can push the assumability as a component of the deal, and I don't think a lot of sellers are sophisticated enough to understand this, and buyers to do it, but you can actually add value to your building because of that additional financing, right? So all of a sudden you have value that you can bring to something that you might not have been able to sell before in whatever position that you were in.
Yeah, right? Like I have one that's like 1.85%. I'm sure if I put up a flag saying this is large assumable debt, I would get a higher price than someone just going to market and trying to get a rate of 4.5. And the other important point is, with apartment buildings, when we go to sell them, we're looking at massive like penalties. This may not be the case if you have a low interest mortgage, because the bank is going to let you off the hook for that because they want their money back to redeploy it at a much higher rate. So you may not be looking at, $500,000 payout if you go to sell your building, but that debt is always more assumable, especially if it's, 3 to 4 years out. I mean, crap, if you did a 10-year term 2 years ago, you got 8 years of less than 2% on your mortgage, your building's probably worth 20% more than other buildings. Maybe not that much, but there's definitely intrinsic value there. So
yeah, it's interesting to see, like, and I think that like oftentimes we think about the building, but the financing is just as important as the building itself, right? Real estate is a game. I forget what I heard this. It was like real estate is a game with financing with buildings thrown in.
Right? I love that one. So I guess my next question is how is this going to affect price valuations? I mean, we're in a much higher interest rate environment. I mean, you could strongly argue that, hey, cap rates have to go up now. So values on the apartments that we already own must naturally go down. But maybe that's not the case.
Yeah, and I think that is always dependent on the market that you're in. So like what happens in Calgary and Edmonton does not happen in Ontario in the same way. And I know this from my experience in like Florida and Texas. Because what ends up happening in those markets is that you see a lot of build that happens. So you see a lot of additional buildings that come online, developments that come online. You see a lot of new stock that comes on. And it's a lot easier to do that in the US than it is in Canada. And it's also easier to do that in Alberta than it is in Ontario. There's I mean, Alberta has red tape, but nothing like Ontario's red tape. So like you find swaths of Edmonton where they're rezone it to make it higher density. Like it just, you don't see that anywhere. Like I have some of my places in Florida. I just got a note saying that like my zoning is now for like multi-family use zoning. And it was a single family before, and I just like got a note. Here you go. Right. And so they rezone the whole area. Right. And so what ends up happening is that you have more developers who create more density and create more units that help to meet supply if there is a higher demand. Right. But what happens in Ontario, and I know that the federal government and the provincial government want to see more density and more units come online. But the truth of the matter is that the municipal governments are really a pain in the butt when it comes to all of this. There's a lot of the NIMBYs and a lot of the bananas who just they don't care about what you want or what it is. They're going to not allow it. And the provincial government in Ontario right now is passing a proposed bill that will help to alleviate some of the NIMBYism that's going on, but it's just not possible. I think that the municipal governments will find a way to be a pain in the ass, because that's what they do, and they will prevent development. So one of the things in Ontario that a lot of people don't know is that we don't have a lot of multifamily buildings. So if you look at, I can't remember the exact number off the top of my head, but between 5 and 20 units, buildings, there are about 5,000 buildings in all of Ontario. that are
That's incredibly scarce considering the population base in Ontario. That's very surprising to hear.
right. And if you
Yeah,
did the
that's
same thing for
yeah,
like between 20 and 100 units, it would be probably quite similar. And although we have buildings coming online, like I'm trying to, I'm trying to build another, I've got a 23 unit building in Coburg, which is a smaller town, and I'm
yeah.
trying to build another 20 units on the same land. I am getting so much hassle from I've spent probably 40 grand so far on permits and fees. Not on permits and fees, just a planner and a draftsman and talking to the city to try to get them to agree. And you know what they want me to do? They want me to do infrastructure studies. They want me to do shadow studies. They want me to do parking studies. They want me to, they're studying me out the wazoo. So what does that mean? It means that, like, unless you're willing to push hard, you're going to say, get lost.
No,
I'd rather do
the
something else.
bureaucracy level is insane considering the amount of risk you're taking on. Now, just for our listeners out there, he mentioned NIMBYism. So NIMBY stands for not in my backyard. So there's usually a lot of pushback to a development for whatever reason. And I think this is something that, it's been talked about by Pierre Poilievre, putting
Yeah.
pressure on municipalities and provinces saying, get your shit together or we're going to stop your funding. Get the red tape out of the way, get rid of the gatekeepers. And this is what we need. And I think Doug Ford has started by, I think, allowing up to 3 units on a lot or something like that.
Yeah,
It looks like it's a start.
it's a
Yeah.
proposal, right? Until it
Okay.
gets passed, we don't have anything in place, and then it's the implementation phase that takes forever with the municipalities. And you forgot about the bananas, right?
Oh, the bananas. Okay.
Build anything nowhere and nothing anywhere. Those guys. Okay. And they're in the same municipal. It doesn't matter what you suggest to this neighbor. They don't care. They don't want it. It doesn't matter. So like, this is why you have issues, right? Because, and if you have like 3 by right, which is what Ford is talking about, that it's supposed to address some of the missing middle, right? But on top of that though, like, the landlord tenant board is really, really tough for small landlords in Ontario because the process is so onerous. Right now, it takes like between 8 to 12 months to have a hearing. Like, I would say that I'm not a large landlord, but I have quite a few units, and if I have a few units that are that I'm waiting to get to the landlord tenant board, it really isn't going to affect me as much as the guy who has one building or one property, or maybe and has like 2 or 3 units that are vacant, or not vacant, but they're waiting for the landlord tenant board hearing to come through. Like, just say they have like a duplex and they have 2 units that are waiting. How do they cover that? They have to come up with their own money from their own accounts to be able to do this. And if they don't have a reserve fund that they've set aside, they're going to have to take their paycheck from their work and use it to pay for, and it's killing the small landlords, killing them. And I don't know if you could say this is I mean, I don't want to be a conspiracy theorist here, but let's do a little thinking about like small businesses in the US and why you see a lot of small restaurants in the US and why you only see big chains in Canada, right? Because the big chains in Canada, they can withstand all the bureaucracy and red tape that goes on because they have a large organization and they have systems and processes for them to do that, right? I think the same thing is happening to real estate in Ontario. I think that what's happening is, by the bureaucratic process, they're forcing out a lot of smaller landlords because they can't withstand the bureaucracy of the landlord tenant board. So they're actually pushing out a ton of landlords, and like you're seeing it again and again in newspapers, $25,000 of back rent owed, 15,000. I was forced out of my house because of and this is
Creating
all
a housing crisis, right? That's why there's such a shortage of rentals. Like, you try to rent something in where you live and it's probably damn near impossible. There's no
sub
incentive to be a
1%.
landlord at all. What's
Yeah,
that?
and it's sub 1%, but also like those small landlords, they're getting so like, and they tell their friends, and that makes it, and they're like, I don't want to do this because that's going to be crazy, right? So like you
Yeah.
have to, so you have to have some, you have to have systems and processes. Like I've written 2 books on property management in Ontario, and you know the reason that I wrote those books was to keep those, make those procedures really transparent so that anybody can use it. I don't think that the landlord tenant board is challenging per se. It's really like about following the right process and procedures. It's very procedural. The big piece that I see that is problematic is the fact that there is like the delays that happen, and the fact, like, if you're a business owner and somebody told you that 80% of your problems are going to come from, you know, one widget, what would you do? You would probably spend a lot of time and energy fixing the widget so you don't have that problem, right?
Yeah.
So in the landlord tenant board, 80 to 85% of all of the problems that happen at the landlord tenant board, the like all of the filings that happen, 80 to 85% are non-payment of rent. Okay, so if you ran a business and you knew that non-payment of rent, you would create a process or a system that streamlines that 80 to 85% so that you could deal with the other 15% that take up a lot of time, right? But not the, so like, again, this is a bureaucracy. It's a bureaucracy, and we're all like, this is government, right? All government is like this.
I live in British Columbia, Quentin, and I can tell you it's very much the same thing. Very low vacancy. It's a housing crisis. We got people, you know, on the streets everywhere. But just going back to recent history in Ontario, you mentioned, you know, the larger chains, the businesses that survive while the little guys got shuttered. I mean, just look at the pandemic. Who was allowed to stay open and who was shut down? We saw that right there. And then we had guys like Doug Ford coming on television and saying, "Don't pay your rent, buy food instead." What the hell do you think the outcome of these kind of policies is going to be? But before I go off on a huge rant, I just want to go backwards a little bit. It's been a
Good idea.
fabulous,
Good idea. We could get really
fabulous.
crazy about this, Cory. You know,
We're gonna get going here. You've been investing since 2004. I think I
yeah.
heard it somewhere before that you were a teacher. Is that correct?
Yeah, I was I have my master's in education. I've got actually 3 degrees, and I was
Wow, I didn't know
a
that.
consultant. I have my principal qualifications. I left teaching in 2013, 2014 to work on my business full time. So I was a full time investor from that point on. But I had been investing in real estate. I actually really started to get into real estate in 2008. So I started to buy 3 or 4 properties a year. By the time I got to 2013, I had about $5,000 a month in cash flow from my assets. I was doing the BRRRR strategy from like 2009 onwards, but we called it the buy, fix, refinance, and rent because that was our strategy that we were using. I actually connected with one of my partners today, Andrew Brennan, and a good friend of mine, Jeff Woods, and we wrote this book together, The Ultimate Wealth Strategy, to talk about that, you know, how we were doing it. And yeah, we were doing that was back in 2012 or 13 that we wrote that book. But yeah, it's been a great ride. And then left teaching. I flipped dozen properties when I left teaching for the first year. Made a lot. I did rent to owns, did wholesales, did a bunch of different stuff. Then in 2015, really focused on apartment buildings. But yeah, I was a
Around
teacher.
2004. So you bought your first property in 04. So
Yeah,
from 04 to 14. So for that 10-year period, you were probably a busy guy. I mean, you had a young
yep,
family, your kids are the
yep,
same age as mine. You were working
yep,
full time
yep,
and you were doing real estate as a side hustle, just
yeah,
getting going.
yeah.
How did that work at first? The first few
Oh,
properties, how did you juggle all that?
I felt like I had 3 jobs. What I learned is to create systems and processes. So the best thing I ever did was I used at that time, there was really the only service I could find. It was called Grasshopper. It was a virtual phone system, and it allowed me to create my own phone lines. So I had like a line for emergencies, a line for maintenance requests, and a line for like tenant questions. So
Ah,
the only time I ever answered a phone call was when an emergency line went off. Everything else was a process and system around, right?
So you didn't have any property managers. You self-managed your whole
Yeah,
portfolio yourself.
yeah, for too long, actually, until, funny enough, until 2013, when I when I left teaching, then I really should have done it for that long, but I ended up hiring on an in-house property manager and administration, and doing a lot of that stuff. Probably should have done that sooner than I did. But yeah, I felt like I had 3 jobs for a while there. It was very stressful, and trying to pull everything off. I was really good at balancing all the different things. I probably was on my phone way too much, for a good year or two, maybe like 3 years. I would say I was probably on my phone way too much. But after that, I started to, figure out a lot of different things. I started to create income from a bunch of different sources, right? I've got, well, the books don't really, like, I've got 6 books, but you're not going to make a living off of books unless they're like a bestseller, right?
Rich Dad,
And
Poor Dad.
yeah, even even if you do like bestseller of this category, it doesn't mean diddly on Amazon, because there's just so many other books out there, right? But I have different different opportunities that have come along, right? I've been I ran the Durham Club. We've got close to 300 members.
That's impressive.
I have a coaching program that I don't do the coaching anymore, but that I run a mastermind. I'm running a course on December 10th and 11th on multifamily with my partner in Toronto. So we've got like a 2-day course, and we've got like 50, just over 50 people that are attending, and it's like $1,700 to attend. So between both of us, we're going to do pretty well on the weekend. So like things like that.
Well, I'm gonna have to roll that one out. Like when you talk to my students next week for our call, you'll have to introduce that, because that call's on the 30th, so they'll have time to get in on that. Because I have a lot of my students are in Ontario, and they would love to go to something like that.
Yeah, actually, it's very specific for Ontario people, because we're talking about the process that we use in our niche strategy, which would be something that I think would be benefit to them for sure. And we're also going to be, we'll be streaming it as well, so it should be a good because we have some people from Northern Ontario and Quebec that wanted to attend, and we're like, oh man, how do we so we decided to stream it, so it should make it a little bit easier for them as well. But like all of a sudden, like all these things started to come in as soon as I stopped teaching, right? Like all of a sudden I started to get all of these, and people approached me, and like I started to invest in some private equity, and I learned about option trading, and I did a little bit of that, and then private lending, and I did a little bit of that, and so I started to learn about having multiple income sources and different ways to get my income in, plus all of my real estate assets, right? I personally have about 125 million in assets, should be a little bit more after this next closing, right? So and that, I mean, that's quite significant, and I own between at least a minimum of 25% of those assets up to 100%, right? And so it's quite a significant amount, plus all the cash flow that comes from those assets as well, right? I've got a triplex that cash flows $2,000 just as is per month, right? Like, and that the one asset, right? So it's just, it just builds up over time. And I'm not really a big spender. Like I don't have I have my truck, which I like, and that's about it. And I like going on vacations. Like I just came back from Costa Rica yesterday, went for 5 days, but I took 22 people with me, and we went down and we looked at properties for like Saturday and Sunday, and we did like like a tour, and we went down to see Rob Brake, who's a Durham REI member, but like
just did a podcast with him last week. It was just aired last week. Great guy. I love Rob. He's awesome.
Yeah, so like when we saw him, we were there with him. We saw Jen, his wife, and we were,
Yeah.
and his kids were well, they were playing, but like they're down there, and then talked to them and looked at their lifestyle and enjoyed, catamaran sunset tour and like some, looked at some properties, and then enjoyed the beach for a little while, which was really good. So I love like stuff like that, right? So those are the type of things that I do: travel, Kilimanjaro, Machu Picchu. That's where I like to kind of spend my money on, and with different experiences that I have. Every person is different. You got to figure out what your goals are. Like my partner has a McLaren, right? And he loves his McLaren. Like he's a great guy. He deserves it, because that's what he's always wanted to have and do, right? So good for him, right? So everybody's got to figure out why are they doing all this, for what purpose, right? Because
your why is so critically important. And I just wanted to go back to the teaching thing, because in 2004, when you got the real estate bug, it's not like you weren't already successful. I mean, you had 3 degrees. I mean, you had a very illustrious career. You could have probably kept that going for some time. What made you decide? I don't want to say that it wasn't enough, but there was something that was probably calling you to real estate. What was it that made you go in that direction?
I had done a lot of side businesses before that too. So like
Okay.
I had done consulting for textbook publishers. I had done projects that, like, written curriculum for the school board. I had done like lots of different things that are out there. I did virtual teaching like back in 2004. Right. So I was where people are like doing Zoom today. I was doing that like well before it was cool. So, but I mean, like, I think what happened was I had a lot of different things that I enjoyed doing. And I was finding that a lot of my time was being, I was spending on teaching. But I wasn't getting the same amount of return from that time that I did, or enjoyment from it as much as I had done. And I found out that I could still do teaching through Durham REI. So I got because I'm still a teacher. I still enjoy explaining difficult concepts, and I still enjoy that. So I get to do that through Durham REI, through the monthly meetings. And then I can focus more time on the real estate and then other goals and things that I have. But like, I think what it was that I knew that I could do better for my family and myself if I went down the path of real estate, just from some of the projects that I had already done. Like I had bought a pre-construction house in 2004. And then by the time 2008 came, it was worth like $300,000 more. And it was more than all the income that I had made. Like, I was like, this is silly. Like, this is like, what the, right? And it was just like, okay, so this is something that really works, right? And then continuing to take that and scale that, I learned through the Real Estate Investment Network, so REIN, back in 2008.
Well.
Yeah. And that helped me to build my network of people. And some of my friends that I met back then, they're still my friends today. Like Ian Zabo, I met back in the REIN days, and we were in Costa Rica together with him and his wife, and we had a great time. And so like, though, you build your team, you build your friendships, and then it takes you in different directions, because the people who you hang out with help to determine, good or bad, what direction you're going to go. And if I stuck with my teaching friends, I would still be a teacher today. But I ended up expanding out my friendships to different people who took me in different directions. Like it's funny, but my wife doesn't always get along with my business friends, just because she's a teacher, okay, and she loves her kids, and she loves that process. But like, I deal with people who are blunt and tell you what they think, and they're not worried about your feelings. They don't care about like whether they're offending somebody or something. It's like, this is how it is, right? And she's not used to that, because it's everything sugar coated, right? And so so those people
politically correct.
I am I am a lot less politically correct than I ever was. And you know what? And the other piece is that they're business minded, and like it's a different value system for them, like what they're doing, right? And so and I understand that. And you know, I like that, right? Because I like to be a no nonsense person. I don't want to like tiptoe around something. I want to tell you what it is, what the problem is, so you can fix it. Not so that we can make everybody the same. Like, you know, you don't punish in schools, you punish everybody for somebody's mistake. In business, you punish the person who made the mistake.
Yeah, you punish the offender. I want to ask you a question about time, and you touched on this during the summit, and you did an interesting poll on return on time. And most of the attendees is if do you know what this is? And hey, do you know what return on time is? And almost nobody said yes. It was like 80 to 20. Do you want to just talk about return on time and the value of time?
Sure. So like there's a few different criteria that I use for people, like I call them key performance indicators. One is net worth. One is your return on equity. So if you have equity in a building, you want to be able to see if you've got like a cash flow from that building, mortgage pay down from that building, and what percentage return that is, right? And if your return is below, let's say 8%, then you should probably recycle that capital and put it somewhere else. The other concept that I had mentioned was return on time. And not a lot of people do that because when you look at your portfolio as you grow, so some of you may be starting out and you know you may not be thinking this way, but as you start to grow your portfolio, you get to say you get to 3 properties and 5 and then 10. And then you look at your portfolio and you say, okay, how much time am I spending on each of these assets? And what you'll probably find, because it's that, you know, it's the Pareto principle. Usually 20% of the assets cause 80% of the problems, right? So
factor. Yeah, absolutely.
Yeah. So if you take a look at your asset base and you figure out, okay, which of these assets am I spending the most time on, and what type of return am I getting from the return on equity from that time that I'm putting it there, right? And what you'll probably find is that there'll be some assets that you get a huge return on time that you don't spend a lot of time on, but you get a lot of wealth from it, or you get a lot of cash flow from it. And what I find is that my apartment buildings, and what I learned back in 2015, is that from a net worth perspective, apartment buildings are the best return on time that I have ever invested in, right? It's just
me as well.
Yeah. So it's the return on time that I like. The amount of time that I spend on something is based on the amount of return that I'm getting from it. What I have found, like, is that there are a lot of people that may look at their single family homes and say, well, my return on time is gigantic because like I get good returns on them and I spend very little time managing that asset. I want to separate management, and this is something that I probably could have done better, property management from the return on time criteria.
Yes.
Because some of the people were thinking that it had to do just with management. It's not just about management. It's about the overall time that you spent on the asset. What you should do is put a property manager in there on all your assets and see, okay, with the manager in there, or your own property management company if you have one, or like whatever your business is like, and then see, okay, with that in there, how much time am I actually spending on that asset? Because there will be assets that just require more of your time because there's issues, or your business plan is more difficult, or there's challenges. Like I find that I have a couple of apartment buildings that take up a lot of my time, like way more than all of the other assets put together, even though I have management in place. So what does that mean? It means I want to get rid of those assets, right?
So the important point there is an apartment building is always intense at the beginning. You got to factor that in, right? There's more sophisticated due diligence period, longer closing, financing than a single. But what people misunderstand, at least when it comes to multifamily in my world, is they see this as a 20-suite building. Man, I got 20 toilets, I got 20 tenants, I'm never going to have any time. I'm just going to be married to this. But for me, it's the opposite. I've learned to just get the hell out of the way, let my property manager do his thing. They did a complete BRRRR on my building in Leduc, and I talk to them maybe once a month. They have a system in place to do this so well They get contractors cheaper than I ever could get it. They do this all the time. They know the market better than everybody. It was almost hands off for me. So for
Yeah.
return on time and cash, that thing is just amazing. I couldn't get on it on any other asset class, in my opinion.
And that really has to do with like your property management, the property management that you have in place, and that's a good return on time. So one of the things that I have that's kind of unique to me is that I have a like a vertical integration, right? Because in our larger buildings, we have our own property management company that's in place, and that they're managing 1,000 units right now. Right. So that property management company allows us to have that scale. And also what I find is that having the right property management company can be a challenge, right? It takes a challenge.
Huge.
But once you find them, so what we did was instead of finding them, we created one, right? And so that allows us to, like, what I've been finding is that when we do unit turnovers with third-party management, it's costing, I had one quote me $40K for a unit. I almost blew a gasket on the property, like the owner. I was like, this doesn't even make sense. I could like, anyways, let's not go down that path. I was able to negotiate a lower price on that unit because I wasn't going to pay that if she wanted to keep my business. And then at the same time, I'm doing unit turnovers in our own management company for $15,000, right? Versus almost 3 times what I'm being charged and 2 times what I'm being charged in a third-party managed unit. So there's a bit of a back and forth when it comes to this, but I think that having the right management in place is really the key. And if you have a good one, it's really awesome to have that. But you have to remember that all property management companies change over time, because
absolutely
they move from they're really great at 200 units, they're good at 400 units, they get to 500 units and they're crap. Right. So it's really about making sure that you're managing the managers, and that's a piece that not everybody talks about, but definitely is important.
Hey, Quentin, top of the hour. I'm going to have to cut it short there, but I think this is definitely going to be a part 2 episode. I think we just got going on a lot of topics. There was a lot of things that I wanted to ask you. So I'm just going to stop the recording. I'll just get you to hang on for 1 minute. And then I want to thank you again for being part of episode 7. This is definitely the most engaging episode I've done to date. I want to really thank you for your time today, Quentin.
Oh, hey, no problem. If anybody wants to reach out to me too, like the best place to go is QuentinD'Souza.com if you wanted to book a 50-minute call, or you can check my podcast out at GetRealWealthy.com if you want to listen to me chat for 8 or 10 minutes a week and get some insights.
Awesome. We'll post those links when we air the episode, Quentin, and look forward to connecting again.
Awesome.